Welcome back to the Deep Dive. Today, we're digging into UniCredit's third quarter 2025 results. They dropped on October 22nd during European trading.
Yeah, and it's a fascinating one this quarter.
Absolutely. Our goal here is simple. Break down the numbers, make sense of the CEO's strategy message. He talks a lot about their DNA, and maybe most importantly, figure out this contradiction. UniCredit called them record results.
Best 9 months ever, I think was the quote.
Exactly. But the market, it pushed the stock down over 2% right after. So what's going on? Did the market see something management didn't highlight or maybe miss the bigger picture?
Well, it really feels like one of those earnings beats that maybe fails the sniff test for sustainability. Let's hit the headlines first because, financially, it looked like a knockout quarter on the surface.
Okay, give us the numbers.
Right. So UniCredit pulled in $2.6 billion in net profit for Q3. That's up 4.7% compared to last year.
And how did that stack up against what analysts expected?
Comfortably beat it. The Refinitiv consensus was hovering around $2.4 billion, so a clear beat on profit. Revenue also came in strong at $6.1 billion, ahead of expectations too.
Okay, and earnings per share?
Reported GAAP EPS, that was 1.71, also up about 8.6% year over year.
So profit beat, revenue beat, EPS beat, like you said, a knockout, but then the stock drops. Over 2.3% down on the day, and on pretty heavy volume too, right?
Yeah, volume was about 40% above average, so the market was definitely paying attention, and, well, it didn't seem convinced by the narrative.
So why the skepticism? You mentioned sustainability. Where's a weak spot?
It really comes down to the mix of that revenue, the quality of the beat, as they say.
Yeah.
When you unpack that $6.1 billion, the main driver wasn't the core banking business. Net interest income, NII, the basic money banks make lending versus deposits that actually declined. It was down 5.4% year over year.
So the pressure from those Eurozone rate cuts is finally biting into the core earnings power.
Exactly. That's the pressure point everyone was watching for.
So if NII was down, where did the strength, the beat, actually come from?
Well, two main places. Fee income was solid, up about 7.6% year on year, which is good. But the real kicker, trading income.
Trading, how much?
It hit $432 million for the quarter. Now get this, that's more than double what they did in Q2.
Wow. Okay, so a huge spike in trading income papered over the weakness in NII.
Pretty much. And, trading income is notoriously volatile. Relying on that to fill the NII gap, that makes investors nervous about the next quarter and the one after that.
Right, that makes the quality of the beat concern crystal clear. The core engine is slowing, and something less predictable plugged the hole. That immediately brings up the capital question. UniCredit generates a ton of capital. Where's it going, especially now?
They are an absolute capital machine. I mean, their CET1 ratio, that key measure of bank strength, is sitting at 14.8%. Really robust.
Very strong.
And management's doubling down on shareholder returns because of it. They confirmed the total payout for 2025, the full year, will be at least $9.5 billion.
$9.5 billion. That's a serious number.
It is. And cash dividends will make up at least half of that, $4.75 billion. We actually know the interim dividend payment is coming up soon, November 26th. It's about $1.43 per share, roughly.
Okay, huge returns promise, but didn't they do something different with a big chunk of capital this quarter? About $6.5 billion.
Ah, yes. The big pivot. Instead of just funneling that excess capital into standard share buybacks, management deployed it early into what they're calling strategic minority stakes. Basically, share buyouts.
Share buyout. Right, that sounds like M&A language, is it?
It kind of is, yeah. And it's definitely controversial. Management had to spend some time justifying it on the call.
How did they justify it? Because shareholders usually expect excess capital back via buybacks, right?
They do. The CEO's argument was essentially about return on investment. He claimed they deployed this $6.5 billion at roughly a 20% ROI.
20%. How does he get to that?
His calculation is that investing in these stakes generates about twice the return compared to just buying back their own shares at current valuations. He framed it as boosting the numerator, the earnings, instead of just shrinking the denominator, the share count.
Okay. But isn't that swapping relatively certain buyback accretion for, M&A execution risk, taking stakes in other banks?
That's the pushback, absolutely. He justified it by arguing these stakes provide us structural long-term lift to earnings, making them less reliant on that volatile NII. It's about diversification.
So which stakes did they take?
Two main ones were detailed. An approximate 26% aggregate exposure in Alpha Bank.
Okay, in Greece.
Right. And then a 26% voting rights position in Commerzbank.
Commerzbank. Interesting. Germany, what's the expected financial payoff from these big bets?
The target is pretty ambitious. They expect these stakes to add about 1 billion to annual revenues and fully distributable net profit by 2027.
€1 billion. Okay, that would certainly help offset NII pressure if it pans out.
That's the plan. It's their structural hedge against falling rates, essentially.
The Commerzbank one seems potentially riskier given its checkered past. Did they talk about managing the downside?
They did. They were clear that while they benefit from the upside, if Commerzbank stock does well, they've got put options in place to protect the downside.
Hedging it.
Exactly. Now, that insurance isn't free. It creates some hedging costs this year that flow through the P&L slightly. But, it provides that crucial risk management piece that analysts are definitely going to watch like hawks.
Okay, look, shifting gears from capital allocation back to the core bank operations, the efficiency numbers they reported looked, well, frankly, incredible.
They really are world-class. This is where phase one of their transformation really shines. Return on tangible equity, ROTE, hit 19.1%.
19% ROTE, that's very high for a European bank.
It is. And maybe even more striking is the cost-income ratio. It dropped down to 37.1%.
37.1%. Just to pause on that, that means for every euro of revenue they bring in, they're only spending about 37 cents to earn it. That's phenomenal efficiency.
It really is sector leading. It makes them look, like you said, less like a traditional big bank and more like something much leaner that's core to their whole DNA message. Efficiency driven by scale and tech.
Okay. And what about credit quality? Any warning signs there given the macro outlook? Cost of risk?
Still looking very benign. Cost of risk, or CORA, was only 10 basis points.
10 basis points. That's incredibly low. Is the market comfortable with that? Or is there a worry they might be under-provisioning?
Well, management argues it's prudence, not risk-taking. And they point to the fact they're still holding 1.7 billion in overlays.
Overlays meaning?
Extra provisions, basically. Capital set aside proactively, just in case things turn sour down the road. It's a buffer against future bumps. So they're arguing they're being conservative, anti-cyclical. It does help calm some nerves.
Okay, so operationally strong, efficient, good credit quality for now. Let's talk strategy and outlook. Management sounds confident.
Extremely confident. They reiterated their full year 2025 guidance for net profit, around 10.5 billion. That's before any sort of extra management actions.
10.5 billion for the year and longer term.
Medium-term ambition. Net profit well above euro by FY27. And they want ROTE to be consistently above 20%.
Okay, ambitious targets. Where does that confidence stem from? You mentioned the DNA concept earlier.
Right, the UniCredit DNA. It's sort of their framework. Built on, they say, three things. Their pan-European scale, operational excellence, which we just discussed, and innovation.
Pan-European scale. They often mention 13 plus 1 banks, right? What's that about?
Yeah, the 13 are their individual bank entities across different European countries. The time plus 1 is the central holding company. It's meant to signify that they drive synergies and tech standardization from the center, but the banks themselves operate with some local autonomy. It's not one giant monolith.
A house of banks model.
Exactly. And on innovation, they highlighted things like Vodenoyan partnerships, AI investments, basically fintech collaborations and internal tech builds designed to keep pushing that efficiency and improve digital offerings.
Got it. And all this efficiency, this phase 1 success, is now allowing them to shift gears, right, into phase 2.
Precisely. Phase 1 was about fixing the foundation, cutting costs, becoming efficient. Phase 2, starting now, really in Q4, is about offense. It's focused on top-line acceleration and growth.
So spending money to make money, essentially.
Yes. Targeted spending, though. Things like hiring and training, especially in key markets like Italy and Germany, big push on omni-channel digital capabilities. It's about investing to grow the core business now.
And when do these investments actually hit the bottom line, cost-wise?
That's key. They were clear the main P&L impact, both the costs and the expected benefits, won't really be felt until 2027 and 2028.
So they're planting seeds now for future growth.
That's the message. Structural investments today for payoff tomorrow. And they also flag that their rolling 3-year plan, the outlook for 2026 to 2028, will get reviewed and likely updated when they report full year 2025 results. That usually happens in February.
Okay, so February is the next big checkpoint for that strategic update. Good to know. Quickly, geographically, where's the profit coming from now, and where do they see future growth?
Right now, Italy is still the powerhouse. It contributes about 44% of the net profit.
Nearly half.
Yeah. Then you've got Germany and Central and Eastern Europe, CEE, basically tied at 22% each. Austria makes up the rest, around 12%. But the area they consistently flag is the future growth engine. That's CEE.
Okay, CEE focus for growth. And the lingering Russia question, any update there?
Still managing it down. They said they expect to fully wind down and close the retail operations in Russia by the first half of 2026.
Okay, so an end date insight for retail.
Yeah. And importantly, the potential capital hit, the risk to their CET1 ratio from an extreme loss scenario in Russia, has come down quite a bit. It was 130 basis points. Now it's down to around 80 basis points.
So the risk is shrinking, though still present.
Exactly. Being managed down steadily. Okay, and before we get into the really fun part, just the standard but crucial reminder. Everything we're discussing is based on public information from the earnings call and related materials. We're exploring potential scenarios and interpretations.
Absolutely. This is definitely not financial advice. Please do your own research. All right, with that out of the way, let's pivot. We've got this highly efficient bank throwing off tons of capital, making bold strategic bets with stakes, facing some market skepticism. Given all that, what's the kind of outrageous but maybe plausible trade idea that jumps out from this call?
Okay, so the setup really hinges on that efficiency and capital generation. Management has explicitly said their target range for the CET1 ratio is 12.5% to 13.0%.
Right, and they're currently way above that at 14.8%.
Way above. Almost 200 basis points, nearly 2 full percentage points of capital above the top end of their own target. And the CEO was very clear. Dividends are sacrosanct. He strongly implied any excess capital beyond what they can strategically deploy into growth will come back to shareholders.
They're almost too good at generating capital for their own strategic plans.
You could argue that. They might be generating capital faster than they can sensibly reinvest it, even with these big new growth plans. So the outrageous but plausible idea is this. Go long UniCredit, but not just for the regular dividend. You're betting on an extraordinary, potentially unscheduled capital return event happening sometime in 2026.
Above and beyond the already stated distribution policy.
Exactly. The ordinary policy from 2026 onwards is already set at a generous 80% of net profit payout, but this trade idea anticipates more than that. It's based on the idea that their operational engine is so strong, and assuming they navigate things like the Italian bank levy effectively, they'll generate so much organic capital that they'll overshoot even that 13% T1 ceiling again.
Forcing their hand, essentially.
Forcing their hand into another large, unexpected excess capital return, maybe a big special dividend, maybe another huge unscheduled buyback program.
Interesting. So it's a bet on forced efficiency leading to bonus returns. You're saying their ability to generate earnings may be boosted by those new stakes, will simply overwhelm their capacity to deploy it, compelling them to give even more back to shareholders, regardless of market worries about NII, a pure capital compounder thesis.
That's the core of it. You're betting the numerator earnings grow so fast that the resulting capital pile becomes too big to ignore, forcing an extra return.
Okay, let's wrap this up. So UniCredit posts record results. Strategy seems to be working, particularly on efficiency, yet the market hesitates.
Right, and that hesitation seems rational, focused on the sustainability question. Can these non-core drivers, like the trading surge and the income from the new stakes, reliably offset that clear decline in core net interest income as rates fall?
That seems to be the key tension.
It is, and that $6.5 billion bet on the stakes in Alpha Bank and Commerzbank, that's their big strategic gamble to permanently lift that earnings base and diversify away from rate sensitivity. So the final thought, the question for you listening is really this. UniCredit is shifting into phase 2, investing heavily now for growth in 2027 and 2028.
Moving from defense to offense.
Exactly. Will this pivot towards accelerating the top line, combined with the earnings diversification from the stakes, be enough? Will it convince the market that UniCredit's core businesses can actually outrun the headwinds from falling European interest rates? That's the tightrope they're walking for the next couple of years.